The moving average is one of the most commonly used indicators in the world, and this indicator have got one common mistakes that most people make, especially beginner traders, and even some experienced traders still make this mistake. And this mistake is relying on the moving averages to buy and sell your market, especially when the market crosses up and up or below moving averages. And if you do this, I guarantee you, if the market goes into a choppy range, your chances of losing more than you expected on your account is very high. So with that being said, in this video I'm going to show you how the moving average really works, what can you do to maximize your winning probabilities with the moving average. I'm also going to show you some common big mistakes that people make, just like the one that I just mentioned, and most importantly, I'm going to give you a rule-based objective strategy using the moving averages for you to get high probability trades. So let's roll the intro and the disclaimer, and I'll see you on the other side. Let's jump into the moving averages and let's talk about what the moving average is and how it is created. So the moving average is simply the average price movement of any given period that you put into the market, right? So when the market is moving, it creates opening prices and closing prices, and these opening and closing prices, you've got their average of these candles, right? So how the moving average is created is simply by calculating the average of the period that of the candles of the period that you want, right? So for example, if you are using the 5 period moving average, that simply means you are saying the average price movement of the last 5 candles, right? So you want to see the average price movement of the last 5 candles, and let me show you how this works in the market, right? So when you come to your trading platform and you pull out your moving average right here, so in this case this is the 21 period moving averages. So what this 21 period moving average is doing here is that it's calculating the average closing prices of the last 21 candles. And how does this help? That simply means instead of you paying attention to each and every closing price, you can just use a smoothed moving average, because now you're just taking the average price movement. You don't care about each and every closing price of each and every candle, right? So let me just take maybe 30 seconds or so to explain how the moving average is really calculated, right? So let's assume that this was a 5 period moving average. So the 5 period moving average is calculated by finding the closing prices of the last 5 candles, and then you add them and then you divide them by 5, right? So let's say this was our 5 candles. So we are going to we will be taking the closing price of this candle plus the closing price of this candle plus the closing price of this candle up to these 5 candles, and we're taking these closing prices and we divide them by 5. So let's say the closing prices was 6 plus 7 plus 8 plus 9 plus 10, and then we are going to calculate this number and we get the sum of this number and we divide them by 5, and then we plot a graph for the moving averages, right? So the way that this graph keeps growing is very simple. It works like this, right? So let's say this was our last candle, right? And the moving average was right here, right? So when we add another candle here, we take now the new created candle plus the last 4 here, make it 5, and then we calculate the average, and then we plot another line up, another plot there, and then the moving average is going to come and connect all the dots, just like the graphs that we did in mathematics in high school, right? So with this being said, you can clearly see now that if the market is going up, the moving average is going to be following where the market is going, because if the prices are going up, that means the average of that thing is also going up, just like the moving averages, right? Now that we understand how the moving average is created, let's talk about some of the mistakes that people make when trading the moving averages. The first one is buying or selling on the market crossing the moving average, right? So this example that I showed you here is an example of 5 losing trades in a row that came before, just because you were buying and selling simply because the market is crossing over the moving averages, right? Because if you look at this, you are going to see that if the market is crossing up and below of the moving average, that simply means that market is not trending. And as a trader, you always mostly want to avoid the market that is not trending, because if the market is not trending, it spends a lot of time between your take profit and your stop loss, and it is likely to hit either your stop loss or your take profit. So if you look at this market, you are going to see that the market was just trying to go to your take profit and then reverses back here. And then if you look at this here, you can see that this market, you spend a lot of time in one trade until you eventually lose. In the next trade, you can also see that this market, after crossing up and you buy, it just goes directly to the other side. Also, when here it crosses to the downside and you sell here, you are going to be getting out of the market with another loss. Of course, sometimes you are going to win, sometimes you are going to lose. That's why towards the end of this video, I'm going to show you how to protect your account so that you can avoid getting into this unnecessary losing trades, and also how to build consistency, right? But number one, avoid buying and selling simply because the market crosses the moving average. That is not a strategy. You need rules-based strategies that are going to help you out in the market, right? Take number 2 is using moving averages without confluences. So this is just like complementing the first thing that I was talking about, and this is a very big mistake that most traders make, right? So people just simply think that the moving average is grail for your trading, and then you are going to find the magic moving average that the market always respects. That doesn't happen. But the moving average can help you to add confluence to another things that the market does, and that gives you high probability winning trades, right? So that being said, let me talk about how to use moving average correctly. So how do you use the moving average correctly? So there's many ways of using the moving average. You use it whatever way you want, but today I want to show you a rule-based strategy that you can use, and also I'm going to teach you how to build a rules-based strategy in the market based on the moving averages, right? Now let's look into the same market, and let me explain the strategy that I'm gonna show you right now. So for you to build a strategy, there's different ways and there's different tactics that you can use, but the one that I favor the most is if I can get to know this thing called the TAEE, right? So the TAEE simply means I first want to identify the trend of the market that I'm trading in. And next thing that I want to do is I want to identify an area of value. So what is an area of value? An area of value is an area where the market is likely to reverse on. And how do we know that the market is likely to reverse on these areas? There's many ways to do so. Support and resistance, Fibonacci retracements, and a lot of things. Maybe even some stochastic indicators like RSI, like the stochastic oscillator. You can use that to identify your area of value, a point where the market is likely to reverse or to push to the upside, right? And after this, we want to, the E stands for the entry. So we want to know your entry rules around these zones, and also we want to see the exits. So for the exits, we are talking about the stop loss and the take profit, right? So this is a very big issue, because when you are trading, you need to understand that your trading is not all about entering the market. Exiting the market is more important than just entering into the market. So let me show you a rules-based strategies that you can use with the moving averages. So since the moving average is always going following where the market is, because it's a lagging indicators, right? The best way to use moving averages is to use multiple moving averages. For example, in this case, if we add up another moving average here, which is the 50 period moving average here, you are going to see that this 50 period moving average was going to help us to avoid to get into some of bad trades at this point right here. But then you are going to see that when the market was trending nicely, we can see that the market was above all the moving averages, followed by the 21 period moving average, and then followed by the 50 EMA. So as a rule for your strategy, you can say, I want to see the market above both the moving averages, right? So if we see the market both above both the moving averages, and we can see gap between the moving averages, what does this show us? It shows us that the market is moving in a strong momentum, and it's not coming back to any of these moving averages. In fact, it's trying to go further away from the moving averages, and the gap between these two moving averages can show you that the market is in a strong momentum and is moving in that direction. So in this case, you can see here the market is going up, and then we also see when the market is now going to the downside, you can see that the market was now moving, and the moving averages was respecting each other, having the 50 period moving average above, followed by the 21, and followed by the market being below both the moving averages. And this is a sign of us being in a downtrend. Right now, if you look at this market, you can see that the market is still fanned out, but you can see that the price have already started to break past some of these moving averages. And what does that show you? It shows you that this downtrend is losing in momentum, right? Now, that's the first basic way of using the moving averages, and that is where we want to build our strategy from, right? Conditions of the strategy. Now, we want to identify the trend. So how do we identify the trend? So to identify the trend, so we're going to write here, for the trend, we want to see if the market is in an uptrend, right? So if the market is in an uptrend, we want to see the 21 EMA being above the 50 EMA, right? And also the market being above both of these, right? And if you are looking for a downtrend, so let me do an uptrend first so that you can really understand this, and then we jump onto the downtrend example, and then after that we are going to be able to show you some of the things that you need to avoid if you want to be successful trading this strategy, right? So this is gonna identify our trend, right? So the next thing that we want to do is we want to look for an area of value, right? So area of value. So how do we look for the area of value here? Now, the best thing that I can tell you about the area of value is this moving average also can work as an area of value. I want you to look at the market right now and see what has been happening right here. So here you can see the market was moving back into the 21 EMA, and the 21 EMA is one of the best indicators to use as a support or resistance zone, and support and resistance zone is also an area of value. So we can use this moving averages here to be able to identify when the market is moving into the moving averages and then touches the moving averages and then rejects on that moving average, and then we can specify that moving average as an area of value, right? So now, before I go into the entry and exit, let me give you a full step-by-step strategy using an example of the trade that I placed earlier today. Okay guys, so I just placed this trade right here, And then as you can see, I'm relying on the moving averages and the market coming back into the moving average and rejecting. And also I just shared this strategy with our members of the Trading with Tan inner circle or the Tan Academy, right? So as I just said, check out this swing trade on TradingView. Good for prompt firm accounts, risk 1% to make 1.5%, right? And I later on said this trade is looking good, even though it might take a long time to get filled, right? So now let me explain this strategy step by step. Right, so first of all, we said we need to identify the trend, right? We need to identify the trend. And how do we identify the trend? First of all, we want to see the 21 period moving average being above the 50 period moving average, right? So if this 50 period moving average is right here, this is the 50 and this is the 21. Now we know that this market is in an uptrend, right? The market is in an uptrend right here, and we know that because the 21 is above the 50. And also if you look into our price action, we can see that the market is making an impulsive move, a pullback, another impulsive move, and now we're expecting a pullback, right? So this market is also confirming to be in an uptrend based on the price action. And also we have the 50 and the 21 period moving averages to confirm that, right? So now the next thing that we see here is the market moving, right? So when the market starts moving, we are going to wait for the market to touch the 21 EMA and then get rejected, right? That's when we know that we have our entry, we have our area of value, right? So our area of value now is when the market touches the 21 and gets rejected with the 21 EMA, right? Now when you see this thing happening here, you can see there's a touch here and there's a rejection. And if you don't see this rejection, this is a clear rejection. Why? Because this market have got a long, this candle have got a long wick to the downside, and now it's moving to the upside, right? So right now it looks like I've just missed a trade with one more candle, but I'm just gonna show you since this is just an example. So when you see this, right, so when you see the 21 being above the 50, we see the market rejecting on the 21. The next thing that we want to do is we want to place our buy order on the close of that candle that have been rejected, and we are going to put our stop loss below the 21 EMA, and we want to add some pips. Don't just put it right on the 21 EMA, just add some pips right here, and then use your stop. Your take profit is going to be based on your stop loss, right? So you can also use the indicator called the ATR. You can search here ATR. The ATR is an indicator that is going to show you the average volatility of the market at a given period of time. So you can use the ATR to identify how much the market was moving. So in this case, it was 23 pips because this is the 4-hour time frame. So from the bottom of this candle, right, we add 23 pips going to the downside, right? So we will be around 50 right here, so around this zone right here, and then we are going to do risk to reward ratio of 1 to 1.5 risk to reward ratio. So if you are risking 1%, you are going to be trying to make 1.5%. If you are risking 2%, you are going to be trying to make 3%. If you are risking 10% of your account, you are going to be trying to make 15%, which is very, very hard to do. And I'm going to show you towards the end of the video why you should never try to do something like that, right? Now after this, you can see that the market here is already going up because I entered late. This is an example, but I showed you a live trade that I placed with this strategy, right? So now we can see the market is moving and it's trying to give us, to put us into a lot of emotions right there, but then later on you are going to get a nice win right there, right? So this is exactly how you trade this simple strategy, right? So I must go again into one last example, showing you the bearish example of this, right? Let's go and let me show you the bearish example of how you can use this strategy. here is a market that fits our conditions of the trend, right? So first of all, we want to identify the trend, and for us to know the conditions of the trend are met, we want to see now that this is a bearish example. We want to see now the 50 period moving average being above the 21 period moving average, right? So if you see something like this and you see gap between these moving averages, this is the first condition being met. The second condition is waiting for the market to come back into the 21 period moving averages and get rejected in that zone. And then if you see that, you are going to place your buy trade and follow up where the market is already going. So let's see if we can get something like that in this example, right? So here you can see the market is starting to move back into the moving average, right? And we are waiting for the market to touch the moving average and get rejected. So how do we know that this is a rejection? You can see here what happened at the moving average. I said you want to see the market creating rejection candlesticks. Rejection candlesticks are candlesticks that have got long wicks to either to the upside or to the downside. You can also look for candlesticks that creates a long wick both to the upside and to the downside. And once you see those candlesticks, that shows you a possible shift in momentum in that market. And when that happens, you know that the 21 EMA have managed to work as your area of value. And once you see that, we want to enter the trade when we see the first red candle here, because we are in a downtrend example. So when you see the first red candle here, we are going to put our stop loss. We will calculate the number of pips, the ATR from the top of this candle that was rejected on the 21 EMA. So in this case, we are going to just use the average ATR that we saw, which was 23 pips. So let's just see. So we are going to put your stop loss right there, and then we are going to put your take profit 1 to 1.5 risk to reward ratio, somewhere something like this, right? So if we see something like this in the market, so here is your trade, how your trade should look like before the market even starts moving, right? We see first the 50 above here, followed by the 21. We see the market coming back to the 21, rejecting here, and now we are likely to see the market pushing to the downside, right? So having a strategy like this can work very, very well to your advantage. But I want to give you an advice, right? Having a strategy only is not going to make you a profitable trader, right? Because strategies on their own won't make you consistent in the market. Why am I saying this? Because when I was back testing and forward testing this strategy, I found out that there's sometimes when this strategy can lose 3 or 4 trades in a row, and they left me thinking, wow, how can I make money with such kind of a strategy? Because after making like 5 trades in a row, I followed by 4 losses in a row. So how can I grow my account doing this? How can I profit, right? But I found out that, okay, what makes us profitable as traders is 3 things, right? First thing is the strategy is just one piece of this triangle, right? And followed by what is called risk management and mental analysis, right? So when it comes to mental analysis, I cannot talk a lot about mental analysis right now because it's a module on its own in our Turn Academy course. You can go find that at turnacademy.com. I will leave the link in the description below. But now let me talk about risk management a little bit, right? So why risk management and what is risk management, right? So risk management is basically 3 things. Knowing how much money you are starting off when you start on your account is very important. Is a very important risk management concept. Number 2, knowing your risk per trade and your risk exposure, right? So risk per trade is something that is very important. And how do you determine your risk per trade in the market? So to determine your risk per trade in the market, you want to backtest your strategy and know if this strategy is winning or losing in the market. How much is my maximum drawdown in the past 100 trades or in the past 200 trades, right? So for example, I have this new strategy that I am testing also So this is not the same strategy that I've been showing you, but this is another strategy that I just found out on YouTube, and also I wanted to test it, and also I wanted to know what can I tweak, what can I do to make this the best strategy possible. So as you can see, this strategy have had a very good winning streak here, followed by a very bad losing streak right after that, right? And having a strategy like this, you want to know that, okay, in the past 100 trades or 200 trades, what was my maximum drawdown? How many losses in a row was I getting? So let's say, for example, here, let's say I got like 4 trades in a row was my maximum drawdown in the trade, right? That means for 4 trades in a row, if this was happening to my live account, how much money should that be? So if I put 2% per trade, that is going to be a total of 8% drawdown in the past 100 trades, right? So if the losing trades goes to 11, so let's say I have a strategy that I've got 11 losses in a row, right? How can I make this strategy useful to me if it is also have potential to make 15 wins in a row? What I can do is say, okay, the maximum drawdown is 11 trades in a row. So if I use 1%, my total drawdown at the end of 100 trades was going to be 11%. So if I'm trading an account that I'm not comfortable with it going to 11%, that means I will have to change my risk per trade or my position size to say, okay, now instead of risking 1% per trade, I'm now trying to risk 0.5% per trade. If I'm comfortable with a strategy that loses 5%, 5 trades in a row, if I'm comfortable putting 2% per trade, that means I'm expecting that if this account goes into the west, I can only lose a total of like 12 or 10% from this account. So that is exactly how you calculate you calculate your risk per trade based on the back test that you have been doing in the market. So without these back testing things, you cannot make money. So I'm going to share with you my back testing strategy journal right here, which you can use. This one is the very simple one for beginners that you can use, and I will leave the link in the description so that you can get this document and you can start testing strategies and know exactly what you are trying to do, right? So if you want to become successful as a trader, I would recommend you to only look at this strategy, mental analysis and risk management triangle, and try to improve all this. Backtest your strategy, come up with your best strategies. Your risk management will come from your backtest. Then the mental analysis is something that you need to practice over a long period of time. As I said, if you go to tanacademy.com right now, you are going to get a complete course that teaches you mental analysis and also how to build these strategies. And also you're going to get another advanced strategy backtesting journal or in other tools if you want it. But for now, I want to thank you for watching this video. If you think this video was valuable, make sure you wait for the next video that is coming up, because I'm just going to be revealing this strategy that I've been testing. So if this strategy goes on to be a very good strategy or a very bad strategy, I'm going to show you, because I'm going to spend like 5 hours testing this strategy and seeing how the results are going to be after 100 trades. So if you are watching this video after maybe 5 days or 4 days, you can check out the video coming up on the screen right now. That is going to be the same video where this strategy is going to be tested and you see the result of the strategy. Thank you for watching, and I hope you find success trading the moving average, and I'll see you in the next one. Don't forget to subscribe, like, and leave a comment.